The market is focused on geopolitical theater, but while headlines track borders and diplomacy, the macroeconomic data anchoring sovereign credit is quietly failing. Consensus is bidding on these diplomatic narratives, ignoring simultaneous, unmodeled shocks that are breaking the baseline set by the IMF. Look at Pakistan. The market sees General Asim Munir architecting a diplomatic channel between Washington and Tehran and is pricing this mediation role as a straight credit positive for Islamabad. Diplomatic hosting activity generates geopolitical optionality, not balance of payments financing. The actual binding constraint is the bilateral deposit architecture. The UAE's recent $3.5 billion repayment request signals that the rollover mechanism underpinning the IMF program is already under strain. A more significant failure is occurring in India. The first unmodeled shock is a structural energy import crisis, directly driven by the destruction of the Iran LPG supply route. Arriving in the exact same quarter is a second, independent shock. Forecasts now show a severe monsoon failure threatening domestic agriculture. This chart plots the violation. The IMF modeled energy and agricultural shocks as isolated scenarios. Now, intersecting trend lines shatter the 1.9% deficit target. This traps the RBI. Defending the rupee depletes reserves, while currency weakness amplifies food inflation. With fiscal and monetary policy space depleting at once, India faces a compound ledger failure. The current market spread has completely missed it. Further north, Kazakhstan faces a sovereign revenue interruption. Russia has executed a deliberate suspension of Kazakh oil flows through the Caspian Pipeline Consortium. This model illustrates the mechanism. The IMF designed Kazakhstan's national fund to catch commodity price volatility, as shown on the left. But a physical volume restriction zeroes out the bar, bypassing the safety net entirely. Treating the CPC cutoff as a European heating headline is a massive error. It is a physical volume restriction carrying imminent tail risk for the bondholder. Meanwhile, sudden security deterioration in Mali provides an early indicator that the Wagner Group's security guarantee model in the Sahel is collapsing. Because Mali sits within the shared WEMU regional bond complex, its instability creates a direct contagion pathway. The security deterioration in Bamako is now actively discounting the stability premiums currently priced into anchor credits like Ivory Coast and Senegal. Across multiple emerging markets, including Indonesia's recent accumulation of governance discounts, investors are carrying stability premiums over structural floors that have already caved in. We are extremely cautious on India's sovereign duration. The compound shock demands close monitoring of compromised import cover metrics through Q3. We reiterate our short thesis on Kazakhstan Eurobonds, driven by the unpriced disruption to their IMF program. IMF Article 4 baselines are backward-looking matrices calibrated to past stability. They are entirely incapable of predicting simultaneous, independent tail risks. True outperformance comes from identifying these compound shocks before the spread adjusts. Read the unredacted brief for the full trade blueprints.